Thanks for joining us today on Market Call. I'm Morella Fernandez. Barry Schwartz on the show with us today. He's president and CIO of Baskin Wealth Management. He'll take your questions on North American large cap stocks. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. You can email your questions as well, marketcall@bnnbloomberg.ca. Good to see you.
How you doing?
Good, thank you. North American stock market's coming back today after a dismal Friday. TSX was down, almost 1,100 points by end of the day.
Almost 1,300 points at one point. Gold down, $600 an ounce?
Gold took a beating. What is your take? Was that all just gold correction, or are we anticipating more of the same?
We have to always come up with a narrative to explain everything, right? And so the narrative was the new appointee potentially to the Fed. We'll have to see if he gets confirmed, Kevin Warsh, and people trying to game it out. What his regime going to look like? Is he going to focus on inflation? Is he going to cut interest rates like crazy, which we all know that the U.S. administration wants? All those things. And so if this new Fed chair is really focused on inflation, maybe that's good for the U.S. dollar. That's bad for gold. That's bad for Bitcoin. Of course, things change so quickly, and you can't just make a blanket conclusion as to a Fed chair appointee and how it's going to play out over the next number of years. That being said, do you think macro issues will still dominate the markets this year? I think the answer is duh. Yeah, for sure. For sure. Macro is always on our minds, of course, right? But what I always tell clients is you have to figure out what type of investor you are. So at Baskin Wealth Management, we're long-term Warren Buffett, Peter Lynch style investors. We focus on owning great quality companies that we have some reasonable certainty that they'll be selling more of their products and services over the next 3 to 5 years. The macro stuff is going to come and go. I don't care what anybody's prediction on gold or interest rates or inflation is in the short term. Generally, most people are wrong anyways. What I'm going to focus on is on our companies, on the results that they're producing, and what the company's management is saying. There's been huge reactions to lots of stocks where there's been no impact on earnings, but the narrative is driving the story. Everybody knows, whether it's software quality companies. The market is forgetting the most important thing when it comes to investing, and it's the mathematics of future cash flows. Microsoft reported last week, no impacts whatsoever to software or being disrupted. And it sank. So, when stocks report earnings, you never know what the reaction is going to be. But I'm going to keep on focusing on the company's results, not conjecture, not what someone on Twitter is saying, because it's always going to be scary. But the fact of the matter is, we should feel pretty good about markets heading into 2026. Corporate earnings, extremely strong. Another year probably of double-digit earnings growth. Interest rates have come down a lot. Inflation seems to be pretty tame. What more do you want? What more do you want? What more are we going to get? Okay, let's take a quick break. We'll line up the first phone calls and emails for Barry Schwartz of Baskin Wealth Management. Again, he'll take your questions on North American large caps. Here's how to reach us. Back in a moment. Welcome back to Market Call. Let's start with an email right now from Al, who says Uber has not done well lately. What are you expecting from their upcoming earnings, of course, this month? Barry, we will turn that over to you. Any reason for Uber being a little bit off and down? Well, it's been a really interesting market for some of the high flyers that did very, very well in 23 and 24. I felt it too. A lot of companies that reached nice prices, had great results in 2023 and 4. For whatever reason, the market has decided to focus on maybe the commodity space or international names, and that's fair. Not every style, every type of company works every single year. I mean, obviously, I'm interested to see what Uber's results are going to be. It's one that's caught our eye, given that the stock has pulled back tremendously. We know that Bill Ackman has a significant stake in the company. There's a lot of moving parts, of course. We all use Uber now. It's become a verb, right? It's become a real thing for whether you're ordering food, whether you're going out for a night on the town. The question is, the market's so worried about the next 10 or 20 years. Are we going to be self-driving cars? Is Tesla going to have robo-taxis? We see that Waymo is, potential competitor here. And so, like, it's the same thing as the software thing. Market is focusing on these nitpicky things that it doesn't understand, or complete unknowns. Meanwhile, it's missing some just terrific earnings from these companies that they're reporting. So, I mean, you're getting to a point now where you can buy some really excellent businesses that are printing cash at 20 times earnings. And that's kind of where Uber is now.
Okay, so it's when you're watching?
It's watching. We haven't pulled the trigger. We haven't done a deep enough dive to really make a decision neither here or there. We really like what we own, but it's something that it's on our watch list for sure.
All right, let's get to our first phone call then. Bob's on the line in Toronto. Hi, Bob.
Hi, Maral. Hi, Barry. Barry, I know you at one time liked restaurant brands. Haven't done very much over the past little while. I'm just wondering what your thoughts are on it now. I appreciate your comments.
Okay, totally different space, restaurant brands.
Totally. Quick service restaurants. And so the quick service restaurant space has been under pressure. You've seen the price of Chipotle pull back. We own Domino's Pizza also. That's pulled back. There's worries about inflation, the high prices of fast food for the low-income consumer, right? You go to McDonald's or what have you, get a combo meal. It's now $12, $13, $14, $15, right? That's a lot of money. Obviously, the bad weather that we had start off January is not going to help the results for some of these companies. But focusing on restaurant brands, we think that the company is in the midst of the final transformation of improving their Burger King operations, franchising them. We're going to see refranchising of the Burger King operations very, very shortly. But the bottom line is we think the amount of money it's spending to improve Burger King, that's going to start to slow down in the next year or so. We think Restaurant Brands is going to start to gush cash. As a result, we think there's going to be significant dividend increases as well as share buybacks. The valuation is very attractive. In the last quarter, its comp sales outperformed McDonald's. Tim Hortons is doing fantastic. It's really the turnaround at Restaurant Brands, Burger King division in the United States. International is sizzling. It's on fire. So we think this is a non-AI type name that I think you can sleep at night owning over the long term, especially as we feel the fundamentals are ready to inflect here.
Okay, that was for Bob. Let's go to our next caller then. Steve, or let's go to an email, I guess. Steve has written in, what are your thoughts on investing in JP Morgan? Are you looking at the financials? Are you already invested in JP Morgan?
Well, we have a lot of financial investments for our clients, whether it's National Bank, TMX Group, Brookfield, Berkshire Hathaway. I have a financial pick today as a top pick. JP Morgan, we used to own it. I don't know where my mind went when we sold this stock. Jamie Dimon is one of the best CEOs of banking the world has ever seen, right up there with the name JP Morgan. He's a terrific CEO. He says he's going to stick around for a number of years to go. The valuation, it's at the high end, of course. All the banks have done well recently. With the new Fed chair pick, we'll see how the financials react, if there's going to be significant interest rate cuts. But I'm bullish on the U.S. and Canadian economy as we head into 2026. So as a result, I think you have to own financials in your portfolio. It was a place to be, of course, in 2025. I didn't have enough of them to really make a difference, but I'm sticking with my financial investments for 26.
Okay, let's go to Frank then. Frank's on the line in Toronto with a question. Hi, Frank.
Good afternoon, Marella. Hi, Barry. I have a question regarding Thomson Reuters. I've been watching it for the past year. Obviously, it's gone up its high from July of last year, July of August. Is it a good buy? The earnings are coming this week. What do you expect? And is it on your radar? Thanks very much.
Okay, thank you for the question. The business model for Thomson Reuters, is it sustainable? They do data, I guess.
Yeah, they have a proprietary database of information for law and accounting and healthcare. Those are their big, is it law? Yeah, whatever it is. The big three. This is a company that's growing top line high single digits, bottom line double digits, generating obviously an enormous amount of free cash flow because it's a data subscription model. What is the market worried about? Obviously AI. Thomson Reuters says, don't worry, we've ring-fenced all our data. No one can get access to it. This is proprietary information. The market's obviously taking the other side of the bet. It's pulled back with a lot of other data and software companies. So here you go. You have a fantastic business model trading around 20 times earnings. I never would have imagined that you'd be able to buy the stock at this valuation. So we're attracted to it, but I just don't know what to sell to buy it. But if I didn't own it, this was something that I would take a hard look at.
What did you think of their argument that, basically we've built the ring around our information, no one's getting at it? Is that a reasonable argument to make? Because we're going to hear it from a lot of data providers, I'm sure.
Well, here's the thing. I mean, at some point in time, AI is just going to get so smart and be able to
Wiggle its way
in or create its own data. You just don't know. But it's distribution, marketing, maintenance. These are things that are very important to companies. And of course, when a company pays for Thomson Reuters, all the employees know how to use it, know where to get the data from. They have support. They're not going to just get data from nowhere and figure it out themselves. No, unless you're a business owner and really motivated, it seems unlikely that a lot of these softwares or proprietary databases are going to be disrupted.
Okay, let's get to another caller then. John's on the line in London, Ontario. Hi, John.
Hi, Marella. Hello, Barry. Call them bottlenecks or choke points. The data center build-out has very critical features, one of which is energy production. I own Constellation Energy. My question is on GE Vernova. Done well in the stock. It keeps going up. Should I add to GE Vernova, in your opinion? Thanks very much.
Thanks for the question.
I mean, obviously, these data center companies are doing tremendous, right? GE Vernova, Comfort Systems, which helps build data centers. You name it, whether they're supplying the parts, the construction, the design, this is the place to be. However, we have to remember at some point in time, this is going to cool off. That this is, who knows if it's secular and that growth is going to continue each and every year, or does it reach some cyclical point and at some point in time that we don't need to order any more turbines from GE or any of its products to help build data centers. So that's what makes me nervous about investing in these short-term themes. I can't tell you for certain over the next 3 to 5 years if GE is going to sell more products or services. I'd rather stick to a company with more recurring revenues. But nothing wrong with this. It's a great business, and if you have a view that data center build out is going to continue for a long period of time, probably one you want to own.
Would you consider trimming since the run up has obviously been so steep? Absolutely.
I mean, look at 23 and 24. Some stocks got up to huge valuations. You should have been trimming some of those names. And, if the stock chart is up and to the right, you bought it at 20 times earnings, now 50 times earnings, and there's no real explanation for that. You should be looking at trimming a bit and rebalancing into some cheaper quality names that haven't done anything over the last 16, 18 months.
Okay. Let's take a quick break. We will come back with Barry. He will answer your questions. He's with Baskin Wealth Management, and they'll take your question today on North American large caps. Here is the number to reach us. Back in a moment. Welcome back. Let's go to Alfred on the line. He's in Mountain View, California, with a question. Hi, Alfred.
Hi, good morning. Great show.
Thank you.
My question is regarding XDIV, DIV. It tracks the S&P 500, but it doesn't pay dividends to the shareholders, making it more tax efficient. I would like to know your guest opinions. Thanks.
Okay, XDIV.
I'm kind of confused on that one. I thought XDIV was the Canadian Dividend ETF.
That's what I thought. I thought it was the iShares, right?
Yeah, so I can't answer. I can answer about, I mean, obviously with interest rates coming down, with GIC rates, it's so low and people getting nothing on their in the bank, they're looking for alternatives for yield. There's been troubles with a lot of these private investments as well. So dividend stocks are probably the way to go. You just have to be careful if you're not with some of these indexes, because they're just the same stocks over and over again. Maybe it's all 5 banks. Maybe it's all the integrated energy stocks. So you're getting some great names, maybe some names you don't want to own. I prefer just to pick and choose. That's our style and approach.
The actual stock itself.
Yeah, but for do-it-yourself investors, there's nothing wrong with having this in your portfolio. You don't want to pay a manager like me.
In what situation does it make sense to go for all 5 as opposed to 1 or 2?
There isn't.
Okay.
In my opinion, because you're just taking on the same risk over and over. Either you pick the quality one that you think is going to do the best over the long term, or you go for the bargain basement idea that you think you may have some insight that it's going to improve with the Canadian banks. But, I'd like to own 25 to 30 stocks that I feel is enough in a portfolio, not buy different thematic ETFs for our clients.
Okay. Let's go to Jacob. Jacob's on the line in Barrie, Ontario. Hi, Jacob.
Hi, good afternoon to you. Just your guest about Shopify. It's been going down, down, and down. What's going on with it? Does he have it in his portfolio? Is it a buy or sell or keep it? Thank you very, very much, and have a nice afternoon.
Thank you very much. Okay, Shopify, we know, is a volatile
Yeah,
stock.
I'm fine with it going down because I don't own it, and I wish I would have bought it in 2022. That was the time to buy it when the stock had gone absolutely crushed. I mean, its business is doing fantastic. So this goes back to what I've been saying all along. You have companies that are reporting very strong results, good earnings. Maybe the market's worried about valuation. Maybe the market's worried about some AI risks. Also the NASDAQ has just been on a fire, right? Just doing so well. So it's natural to have companies pull back. Obviously, today's a good day for the NASDAQ, but that can switch on a dime with any macro news. We've stayed away from Shopify, Morella, because of the valuation. It just doesn't fit our paradigm. We like to buy companies that trade at 30 to 40 times maximum earnings, even if they produce tremendous growth. I'm not a high growth investor. And I feel like when you buy these extremely premium price companies, you take a lot of risk, and you should expect a lot of volatility even if they meet earnings expectations.
Okay, let's go to our next caller then. Do we have Betty on the line here? Yes, Betty's on the line in Hamilton, Ontario. Hi, Betty.
Hi, Marilla and Barry. Thank you very much for taking my call. Okay, my question has to do with value investing and looking at a stock like Costco. What do you think are the prospects of being in a retail space and also it being so dependent on membership sales?
Okay, thank you for the question. And they do well on the membership sales.
That's their business model. That's the business model.
And it does well for them, right?
Yeah. So,
we talked about it last year, these kind of business models. The Walmarts were doing great. The Costco's were doing great. The consumer was looking for the lowest price. Yeah. And that was all of the uncertainty of last year. Costco, looking forward.
Yes, Costco skews a little bit higher end, right, because of the membership pricing, and because you really have to have a lot of space to store, the 6 kilograms of almonds that you may buy or 1,000 rolls of toilet paper. But the bottom line is Costco, like a lot of quality stocks, pulled back in 2025, even though its results were excellent, double-digit growth. So you knock your head against the wall. What am I doing wrong? I'm owning such good businesses. The results are better than I expect, and the market doesn't care. Well, you have to go back and look at that chart over a number of years, right? Costco was $300 during the pandemic in 2020. The stock has tripled, right? So bottom line is, I think a lot of these companies, even though the results are great, they're going to get a little pause. Hopefully that's the pause that refreshes. But as long as Costco keeps on growing, and we see no reason that won't continue, we're very excited about it. Costco trades at a high valuation, but it has one of the most certainties and durable business models that we've ever seen. We think Costco can add 30 to 35 stores a year for 20 to 30 plus years and continue to grow its membership because it offers such good value. So we're very excited to own the stock, and any material pullbacks like it did when it fell to the mid 800 level, we were adding more.
Okay, good to know. All right, let's get to Chad in Saskatoon. Hi, Chad.
Hi, Marilla and Barry. Barry, my question's on Amazon. Reporting earnings this week, how do you assess Amazon's growth prospects from here? And would you be a buyer before earnings or after? Thank you. I'll hang up and listen.
Thank you for the question. I like it. I like the question of before or after. Where would you do? What do you think?
That's not how I play the game, right? I talked about you have to figure out what type of investor you are. Even if look at Microsoft, fell 11%. Obviously, I'm excited to buy more when a stock goes down. Amazon has reported earnings many times where it's gone up 10 or 20% or down 10 or 20% when it reports earnings. So you can't learn anything because it's all about if it meets expectations and what it says on the conference call. But we've owned Amazon for our clients and me personally since about 2017. And I think it's one of the best businesses in the world. Jeff Bezos pretty much copied the Costco model. I think it's one of the most inevitable companies that we can ever own, like Costco. We see lots of durability. They've built a complex that no one can catch up to, especially in North America, and they continue to add more value. We see them launching much more in terms of groceries this year. That should be really good for keeping sticky clients. And unlike some other of the Mag 7, it really hasn't taken off. I don't know why, because last year was a very strong year for earnings, so one of the best earnings years it's ever had, and we see more of that coming. So the stock is finally very attractively priced for new investors, and we plan to hold it for as long as we're going to be investing other people's money and my own.
Okay, let's take a quick break then. We will have a look at past picks from Barry when we come back. Time now for a look at Barry's past picks from March 3rd of 2025, so under a year ago. At the time, he chose Meta at $655.05 US. Meta's up to $710.05, 8% return, 9% total return. Meta, of course, did just report earnings last week. I take it you're still invested in this.
I am still invested. We got back into Meta about 2024. We sold a company that we're very happy to sell because it went down a lot more, and Meta recovered very nicely. We just think this is one of the best ways to play AI. Whether or not you believe that these companies are going to show a return on the AI in the future, God only knows, but we're seeing the evidence in Meta's revenues, guiding for over 30% plus revenue growth over the next quarter. They're saying that the AI tools are helping people become more sticky, clicking on more ads.
It's a curated ads, yes.
It's working. So don't tell me that AI is baloney. And in the meantime, of course, because the core business is doing so well, Zuckerberg has let them spend an infinite amount of money expanding its AI. This is one of the companies that that doesn't sell its compute power to others, right? Unlike Microsoft or Google. Meta uses all of its compute just for itself. So spending $115 billion just for itself tells you how confident they are about the future. That's your tell. The stock is trading at a very reasonable valuation. We think it's going to do around $30 a share in earnings this year, and probably going to grow at 15 or 20% a year for the next few years. In the meantime, you never know what Zuck's going to pull out of his sleeve when it comes to language learning models and other AI tools that they're spending hundreds of billions of dollars on over the next 5 years.
Okay, Meta was up. Let's go to Copart from last March. CPRT on the NASDAQ at the time, 54.65 US. Now to 40.09, so 27% drop return, 27% total return drop. This is a sort of vehicle salvage company services?
Correct.
Yes.
I got punched in the face on this one pretty hard. It's been a long-term investment. Great business. It's an oligopoly in terms of auto auctions. If you get into a car accident, your car is going to be probably junked and sold through Copart's auto auctions or its competitor IAA. What's happened in the U.S. with the high price of car insurance, people can't afford the insurance, so they're not
hanging onto their cars.
They're hanging on to cars and not insuring them.
Oh wow!
And so Copart's main competitor is IAA, who deals with Progressive, and Progressive has been selling insurance like hotcakes versus some of its other competitors. So Copart just has the wrong customers right now. These contracts switch all the time. In the meantime, Copart has, I think, 15% of its market cap in cash. And we're hopeful that as insurance prices start to come down, more people will insure again and will boost Copart's earnings. It's getting into doing auctions for heavy equipment as well. There's still lots of white space to expand auctions internationally. So we're very excited to own this company. We think it's just a temporary issue. Nothing to do with its business, but just some of its how it matches up with its competitors. And we think that's going to turn around very shortly.
Okay, let's get to your third pick from last March. Live Nation Entertainment, LYV on the New York Stock Exchange, 142.26 US, now to 145.78, so 2% upside return and total return. This is also a company that has a huge moat. Like they run what they run, and nobody else can really touch them.
It's a pretty huge moat that the Department of Justice wants to break up the company. We got some. I don't know if we got good news, but the judge for the case said that they may even throw this out. May even throw out the antitrust lawsuit. So we'll see what happens, what the remedies are. In the meantime, of course, what happened in the last quarter was not as robust. There was a lot more stadium shows versus shows at its venues that it owns, and that kind of hurt the revenues. But this company's guiding for double-digit revenue growth in 2026. I'm going to do my part. I'm going to try and go to a bunch of concerts. The only problem is all my favorite artists are so old and retired, right? I don't like any of the new music today, but I guess I got to.
You got to get hit.
I got to get hit.
You got to get hit. Even that's old. Okay, let's take a quick break. We'll be back to take your phone calls with Barry Schwartz, Baskin Wealth Management, taking your questions on North American large caps. Back in a moment. Welcome back. We're going to Kevin on the line in Ottawa with a question right now. Hi, Kevin. Kevin, are you there? Okay, we may have lost him. He wanted to ask about TD Bank.
We still give him his question?
We're going to give him his question today. Fine. It's Monday. I don't know why it's Monday. Yeah. So TD Bank, of course, came up a lot last year. It had a bigger gap to close than the other banks. Do you like it moving forward?
Well, TD was priced as if all the bad news was already in the stock, and kudos to the management team. Some of it is just market beta, right? Financials did very, very well last year, and TD recovered with all the Canadian banks. Obviously, up 50+% last year was gigantic. All the Canadian banks did very, very well. They're trading at a high end of their valuation range. The Canadian economy did better than people expected. The defaults on mortgages for personal weren't as bad as people were expecting. Interest rates have come down. The U.S. economy is doing fine. So, TD Bank, I don't like owning companies that have handcuffs on them. They have handcuffs on their ability to grow in the U.S. So I'd rather own, a more clear, less regulated bank like National or Royal Bank. Those are our two top Canadian bank holdings. But I'm okay on the Canadian banks here. If you're bullish like I am on the Canadian economy going forward and the U.S. economy, then I think you still have to own financials in your portfolio.
Okay. Let's go to William. He's on the line in London, Ontario. Hi, William.
Afternoon. Thank you for your past suggestions. I'm trying to make up my mind if I should buy for my daughter more NVIDIA or Micron.
Okay, thank you for the question. NVIDIA's up quite a bit, actually. Yeah. It's been hovering around the 188, somewhere in there. It's up to 198.
Thanks for reminding me. And Micron, unbelievable. Micron is more the memory company. I mean, the demand for memory is gone off the charts. Memory is usually an extremely cyclical part of the semiconductor chain, right? It's easier to make, but of course there's so much demand that we haven't been able to catch up on supply. That's why the Microns and the SanDisks of the world are going insane. Those are commodity type companies. I have no interest in them unless you had a view long term. NVIDIA, I prefer owning Taiwan Semiconductor. It just gives me more comfort to not have to bet on which horse is going to win the race instead of owning the racetrack, as Taiwan Semi makes the chips for every single company and trading at a much cheaper valuation. Yeah, it comes with the China-Taiwan risk. Hello, there's no company that's immune from any risk. With NVIDIA, of course, valuation looks reasonably attractive. If there was a material pullback, I think we would, put up our glasses again and do another deep dive, because I still think that this AI trend is going to go on for quite a long time, and we're already seeing the proof that it's working, especially for companies like Meta and Microsoft.
Okay, let's go back to the phone lines. Frank's on the line in Waterloo, Ontario. Hi, Frank.
Hello there. Good afternoon, Marella and Barry. Hope you're staying warm. I would like to get Barry's take method on how much weight he values the leaders versus other key metrics when choosing buys and sells. And I agree, there is no good bands out there to hit the Live Nation. And have yourselves a great day.
Thanks very much. Okay, so some general rules for buying and selling is what I got?
I didn't really. I think he was talking more about sticking with like the market leaders.
Okay.
That was my takeaway. But I do think there is an advantage to owning companies that have built already billions of customers, whether it's an Apple or a Microsoft or a Visa or an Amazon, right? Especially when they have such strong goodwill from their customers and they keep on adding more products and services. Tesla, hard to know what the future looks like for this company. It's taking obviously a gigantic approach on robotics and power generation. There's a lot of money it's going to spend. Its car sales, like if you look at the valuation of Tesla, I think it's trading at 200 times earnings. This is not a company that's going to say, wow, that's a cheap buy. So a lot of this fantastic news that may or may not happen in the future, it seems to be already priced into the stock. The thing is, it has Elon Musk, who is an amazing storyteller, and obviously he's delivered all the goods, right? He's is he the world's richest guy? Pretty much.
It depends on the day.
Depends on the day,
Yes.
right? So I won't buy it for our clients, but obviously if it ever came down to a reasonable valuation, we would be interested, because we believe in this day and age where AI, you don't know what's going on. The consumer is really scared and frightened about how the world's going to look. You want to stick with the companies that have the best brands, the best distribution, the best marketing that you can trust. I don't know if Tesla has that. I think they've gone back some of the goodwill that they lost for, but I think you want to stick with a lot of these big techs.
And you would buy it on the forward idea of robotics as opposed to EVs?
I don't like to buy on unknown what ifs 20 years from now. EVs, right? We're going to just have to see how these Chinese vehicles play out. If the United States and Canada is going to allow a lot of them in, they're very, the cars seem to be pretty attractive at lower prices. So I don't know if it's guaranteed that Tesla is going to be the main winner. Maybe I don't get it. Maybe Tesla is going to create this robo-taxi platform that's going to generate trillions of dollars of upside. It's possible, but I'm kind of seeing it. It's already in the stock, so it makes me afraid to buy it 200 times.
Where was the robot that was going to shovel my driveway last week?
I can't even get my kids to help me.
Exactly. Let's go to Frank, another Frank in Thunder Bay, Ontario. Hi, Frank.
Hi there. I'd like to get Barry's opinion on Constellation Software. I'm curious if he's still bullish on it and what he'd be looking for in the next earnings. Thank you very much.
Okay, thank you for the question. Constellation Software suffered quite a bit, as
Oh my.
I'm sure you've been watching it.
Oh my, it was one of our largest holdings as we entered into 2025, and it's been pretty much cut in half on narrative,
Yes.
and not on fundamentals, right? So what do you do in that situation? Do you believe all the nervous Nellies that are selling the stock, or do you trust the fundamentals? No question, Mark Leonard stepping down and retiring due to a health issue is material to the company. It's like Warren Buffett walking away at age 60 instead of 95. Yes. Yeah, it sucks. But I think the team at Constellation is just so strong. This is a decentralized business. So what am I doing? I'm buying more shares every day. Call me a fool, call me a knife catcher. I don't care. I see the fundamentals of this business, and I'm able to buy it now around 20 times earnings. I still think it's going to grow top line at double digits, bottom line at double digit for many years to come. I don't see anybody replacing or ripping out their software for unknown, untested softwares. That's comments by people that don't understand or have never run a business in their life. In fact, we're looking at a new software at our company to sign up for to help us with things. And if there's an AI advantage or some kind of AI tools that comes with it, great. I'll pay more for that. I'm not going to create my own software or vibe code or do whatever. So, market gets things wrong, right? Remember, it hated Netflix when it fell to $190. It hated Google when it was $160 a share. It's an AI loser. I don't trust the narratives, trust the fundamentals. We may be wrong. I have no idea what AI is going to, how super intelligent it's going to be years from now. But I'm very certain that distribution, marketing, support, and software is really not that expensive when it comes to running your business anyway. So I'm excited to own Constellation here. And if, keep selling it, I'll buy more. I'll buy all your shares.
Okay, let's take a quick break. We will be back with Barry Schwartz, Baskin Wealth Management. Again, he's taking your questions on North American large cap stocks. Back in a moment. Welcome back. Let's go to Joe. He's holding on the line in Richmond Hill, Ontario. He has a question today for Barry. Hi, Joe.
Oh, hi. Good afternoon. The Canadian rails, would you buy them now? And if so, which one would you favor? Thank you.
Okay. I've heard both sides of the argument for rail, so I'm just wondering where you land.
We used to be owners of CN Rail. We also used to be owners of CP Rail. We owned CN Rail till about, I'd say, early 2024. We just got fed up with the fact that it kept on lowering its guidance. It would come out with fantastic guidance and then cut it down. And it seems to be the case every single year. It just can't get its mojo going, whether it's the tariffs or the economy or a bad grain or weather. God only knows. So I just don't want to be involved in a company where there's excuses every single quarter. And the company I saw, it announced a big share buyback. I don't know how they're paying for it. I hope they're not doing it with debt, because that is not the right approach for CN Rail. It's been buying back an awful lot of stock. It hasn't done anything for the share price lately. So I'd rather go with the truckers now. I think there's more inflection with trucking here.
They were really off last year, though.
Yeah. Oh, my God. Tell me about it. We own TFI International. We got decimated on that name, but it's recovered about 30% in the last few months as trucking spot pricing has improved. We saw the manufacturing data out today from the U.S. We're starting to feel
Which
really
is good.
Yeah, it's good. Feeling really good about the U.S. economy. I would prefer CP Rail over CN. I think it's a much better run company. But, you just don't know how this tariff stuff's going to play out, the renegotiation of the CUSMA, USMCA, whatever you want to call it. It's going to get nasty. It's going to get ugly. So there could be another shoe to drop for these railroads.
All right. Let's go to Audie in Waterloo, Ontario. Hi, Audie.
Hi there. I was wondering if I can get Barry's take on Brookfield Asset Management. The stock's been peeling back a little bit the last couple of weeks, and they have earnings on Wednesday morning. I'm just wondering if it's a good time to buy at this point, or the parent corporation of Brookfield.
Okay, thanks for the question. Do you own any Brookfield?
Yeah, we own shares of Brookfield, the parent corp. That's our largest Brookfield position. We also own asset management, and we also own shares of Brookfield Infrastructure Partners. So we're all in on Brookfield, and we've owned a lot of those entities for decades. With Brookfield Asset Management, I think it's not anything specific to Brookfield. If you look at the charts of KKR and Blackstone, they've all pulled back. There's been headlines and worries about private credit and private debt and private equity and halting of redemptions and all these things. Brookfield is not really involved in that part of the private equity business. They have really deal with high quality institutional investors. And so this company is guiding for 15% dividend growth. I think a lot of people are going to start looking for some of these dividend stocks as interest rates stay low here for an extended period of time. Brookfield, I think, can grow its dividend, double its dividend over the next 5 years. And, the potential if people get nervous about stock markets and go back into private equity because all this stuff is cyclical, I think Brookfield is one of the best distributors of private equity.
Do you prefer one of the Brookfields over the other? I know you said you own all three. Would you go to the parent company if you're going to own one?
I prefer the parent company, but it all depends on what you own, what your cost base is. We have some clients who've been in Brookfield for 20 plus years, right? And so their cost bases are extremely low. I can't really sell one to buy the other and cause a big capital gain. I would say if you're an income seeker, you might want to own Brookfield Asset Management. If you're pure income, maybe Brookfield Infrastructure. But if you're looking for the growth, the parent company, Brookfield, is the way to go. It gets it collects all the fees, all the money goes right to the top, and you get the best operators in the world, in our opinion.
Okay, let's go to an email here from Patrick. Patrick says, Barry's opinion on a business with AI opportunities and valuation like CGI. What do you think of CGI? Let's start
there. The consulting names like CGI and Accenture have all pulled back, whether it's worries about AI, whether it's just the fundamentals. CGI had earnings the other day, guided for a pretty good year, pretty good quarter. It's just not growing at the rates that I'm attracted to. I'm looking for companies that grow at double-digit rates, and CGI is growing at high single digits on the bottom line. It's also doing a lot of share buybacks to achieve that. So it's not a business that really gets me excited about. I like businesses where you can sell a product and have billions of customers and recurring revenues instead of going out and bidding on all these contracts. It's a much harder business to be in. So at some point, the valuation may fall to something very attractive. Maybe it already has, but it doesn't fit our bill for a top-tier quality company in our portfolio.
Okay, let's take another quick break. We have new top picks from Barry when we come back. Stay tuned. Join us tomorrow on Market Call. Tim Regan will be on the show. Managing Director at King West & Company. He'll take your questions on North American large caps. That's tomorrow. And time for new top picks from Barry Schwartz. We're going to start with Microsoft, MSFT on the NASDAQ. We talked about Microsoft coming off after earnings, but you see no reason for that. Are you picking up more?
Maybe there is good reasons that I'm missing, and that's fair. And also, just you try to make rational sense of market moves in the short term. You cannot, right? And so I think the headline was Microsoft missed on the whisper number for Azure. It's not the actual number that it produced. It's the number that people thought they might beat.
The estimate, yes.
Come on. And so whatever. I mean, Microsoft has pulled back tremendously, as is Oracle, as is a lot of companies tied to OpenAI. People are, talking about its remaining performance obligations that it has with OpenAI, and is it ever going to make real money? I think the proof is in the pudding. Microsoft said they would have had greater than 40% growth in its cloud division, but it put computing power to its own products like Microsoft Copilot, which is growing very, very quickly. So it's very rare to find a high-quality company like this trading well below 25 times earnings. I think Microsoft is going to grow top and bottom line at double digits. This gets me excited. The stock has pulled back tremendously. I think it's just a short-term blip, and there's no evidence in the numbers that anything's going the wrong way. In fact, things are accelerating and improving.
And what an advantage it has by being all over offices with its Microsoft model and then putting Copilot into that. It's the automatic go-to for a lot of people.
We pay for Copilot, and I got to tell you, it's worth every penny because it does things that would have taken up a lot of time and effort for a very little monthly cost.
Okay, let's get to your next pick. MSCI on the New York Stock Exchange. This is a company that does data essentially for investing. Tell me a bit more about it.
Yeah, so everybody's heard of the MSCI indices. It has about 30,000+ different indices. So asset managers use it to benchmark and to create new products. Hedge funds use it to test and backtest data and for trading strategies. Banks use it to create derivative products. So everybody pays. If you're in business, in the financial business, you pay for MSCI. Everybody's heard of the S&P 500, the TSX. MSCI owns more international indices. We saw the fantastic year that international stocks had last year. This is a boon for MSCI, and the bloom is maybe off the rose on some U.S. stocks. So if there's more products created around ETFs, around international, this is going to be fantastic for MSCI. You have to pay them. The margins on their products are near 100% because it's just organizing data for you. This is AI proof as well. They're getting into privates, they're in ESG, they're in climate, and still other avenues for it to grow. Valuation is not cheap, but this is, in my opinion, top 5 world's best business we've ever seen. 95% recurring revenue, near 100% margins. The data can't be replicated. It owns it, and everybody who wants to sell financial products has to pay them.
Is it a dividend stock?
Not really. But it was aggressive buying back its shares last year, bought back 5% of its stock just because the share price had underperformed over the last 2 years.
Okay. Let's get to your third pick then. Well-known name Netflix, NFLX on the NASDAQ, pulled back a lot as it is in a bidding war with Paramount Skydance for Warner Brothers. It's down to 83.63.
Yeah. Once again, here's a name that's shooting out terrific results, and the market is focusing on nitpicking on unknowns. Is it going to get Warner Brothers? No one knows. Is it going to go through? Nobody knows. Is Paramount going to raise its bid? Nobody knows. But all I know is that Netflix reported 13% revenue growth in the last quarter. It's guiding for near 20% profit growth going forward. It's adding all new programming, whether it's Stranger Things, whether it's wrestling. It's getting more into live sports. It's growing its subscribers now at 325 million subs, up 8% last year. It has pricing power. And you just don't know what other services it's going to get into. It's trying with video games. It's getting into podcasts. And I think the next thing is to start to compete against YouTube and Meta for the short form video.
Are you worried about how much money they're going to spend on Warner Brothers if they get it?
No, because if they get it today, I think they're paying like a pauper's price for an amazing quality business with some of the best IP, right? Harry Potter. I watched the new Game of Thrones. The Dunk and Egg, it's pretty good. So there's there's such great programming that it can use to grow its business. We think it's buying this at like 10 times free cash flow. We're very excited whether it gets Warner Brothers or not. It was a chance it has to take. And I think at 20 times earnings for one of the world's best companies, you'd be silly not to buy it here.
All right. Thanks for joining us, Barry. Good to see you.
Thanks for having me.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.